Hey, everybody. Good morning and welcome to another edition of the Biotech Capital Compass's video companions, as I'm calling them. These are just essentially a way to outline and synopsize, newsletters that we write, especially newsletters that are sort of like overly complex. Um, the Biotech Capital Compass is tailored towards biotech specialists, but we also want it to be accessible to the biotech non-specialists. That's really important for me because in order, I believe, for folks to really want to invest in biotech that are non-biotech specialists, but love investing or love finance and want to manage their portfolios more themselves, biotech should be accessible and not, idiosyncratic or a mystery. And this is what these companions are meant for, is to really provide a free kind of explanation for complex newsletter that we wrote so that people can listen to it, learn from it, and if they want to then subscribe or become a paid subscriber, which helps us a lot, by the way, that would be great. And for our paid subscribers, this serves as sort of like an appetizer for a more complex read that is the newsletter. So you can listen to this and then get into the newsletter. So let's get going. This is the second one, and it's really focused on Krystal Biotech, which is a small, or now it's actually a mid-cap company that we wanted to highlight. And this is a really interesting story. I didn't want to highlight it just from the investment perspective, but also as a story, it's very unique. And biotech has tremendous unique stories. This is one of them, which is why I wanted to highlight it. And this is really talking about a biotech company that many investors think that they already missed. The stock's gone up so quickly, especially over the last few months. And I've been kind of tracking the stock for many years, met the management team, the current CEO a long time ago, always felt that I, missed it, quote unquote, when I was on the sell side as an analyst, didn't cover it. It's a great story, not just about the company, the origin story, but also the disease, which they've gone after the first one, really, really difficult disease, and with patients in great unmet need. And what they've created is something really unique. So let's get into it. The stock is up a lot. The product is approved, the first product, the revenues are real. So the natural reaction is what's left to analyze, right? And a lot of times that's what happens in biotech if they're one product companies, like what's left to analyze. Those companies usually get, snapped up by larger companies, or they go ahead and do like BD or develop through their internal pipelines other products and then become over time multi-product companies. But this question, that have we missed Krystal Biotech? That misses the point. This is a story about whether Krystal has succeeded. It clearly has. This is a story about whether the market is fully pricing what a profitable, redosable genetic medicine looks like when it actually works and then starts to compound. That's really what this, trying to highlight with Krystal. Krystal's origin already set it apart. Founded in Pittsburgh by a husband and wife team, initially self-funded, public in roughly 18 months. But the bigger difference was strategic. Krystal didn't try to make gene therapy bigger or more aggressive. They asked a simple question. What if genetic medicine could be redosed? That insight led them to an HSV1 based platform, not one and done, but something closer to a chronic biologic. The HSV1 platform is actually also much larger. Genetic material can be put in it. So unlike what's called the AAV, these are other kinds of viral vectors. HSV1, you could put in a much larger, 3, 4, 5 times larger, genetic material into it versus AAV. And it seems like also HSV1 has had a very safe profile up till now. You can keep on redosing it, and the body doesn't generate auto antibodies against it or an immune reaction against it, which has been a problem with a lot of the AAV-based therapies. So again, their HSV1 based platform, aside from safety, from redosing and also larger, genetic material can be put on it. It's not really that one and done. It's something closer to a chronic biologic. That distinction matters more than it sounds. So really their first product that got approved is Vyjuvek. As always, as like probably anybody else, I have a hard time saying some of these brand names myself. I've been doing this for 30 years. So if you're somebody new to biotech and you like doing audio and video podcasts and you struggle with these names, welcome to the club. I've been doing it for 30 plus years and I still struggle. So again, the first product, Vyjuvek, this first approved redosable gene therapy, it's for dystrophic epidermolysis bullosa, or DEB, DEB. Again, dystrophic epidermolysis bullosa, one of the most severe rare skin diseases out there. And really, in my time of doing, working in biotech, it's really, I mean, I shudder even when I used to see pictures of patients. Kudos to the management team for going after one of the toughest, severe rare skin diseases right off the bat. And most importantly, Vyjuvek didn't just get approved. It's being reimbursed, it's being redosed, it's expanding globally, and it's generating real cash flows. By late 2025, revenues were approaching $400 million annually. That's the threshold many gene therapy companies never cross. I mean, it rarely, literally happens, handful. Once you're there, the story stops being about science risk and starts being about execution. Now, Krystal also teaches us something important about biotech stocks. This is another reason why I wanted to highlight it and wrote in the newsletter. Execution alone isn't enough. Expectations matter just as much. In 2023 and early 2024, revenue expectations moved higher. The stock followed. Krystal hit profitability also. Then expectations got ahead of reality. And consensus pushed 2025 revenues too high. So this is what I'm saying in 2023 and 2024, forward projections of 2025 revenue, which is tracked by Bloomberg, it's called Bloomberg Compiled Consensus, got really high, got up to 500 million. And then what happened was in early 2025, management and analysts realized, and investors too, that the expectations got too high, and this, consensus, management had to reset the bar in the first and second quarter of last year. Estimates came down, and the stock corrected. Even though the product didn't fail, stock was down almost 30% during that time. So that lesson is simple. Vyjuvek didn't stumble; expectations did. And this is not management or analysts or investors' fault. Especially in biotech, what happens is expectations just get ahead of reality from time to time. It happens all the time. This is just called being a human being. Management, analysts, investors, these are all human beings and we all talk to each other. I mean, I did it many times, both as an investor and as an analyst. But when these stumbles happen and the stock kind of corrects, the real question to ask is, was that stumble real? And was there, has it radically changed the story? Or was it just a one-off, and that once these expectations reset, can you buy into it again? And then I think investors, who like to invest even personal, their personal money, not just professionals, understand this. So that brings us to the platform and this flywheel. Now this is where we're getting to the meat of the newsletter. If you're an investor, that's really looking at Krystal seriously. So one of the things we highlighted was the platform and this flywheel, as I called it. In 2025, the FDA granted Krystal a platform technology designation. That matters because prior regulatory, safety, and manufacturing work can now compound across programs. So any one of their programs that uses the HSV1 platform now, the prior regulatory, safety, and manufacturing work that's already been done with Vyjuvek that's approved, now this can compound against across programs. So instead of starting from zero each time, development builds on itself. Timelines compress, risk declines, the flywheel spins faster. But platform advantages are conditional. Safety has to stay clean. Sarepta is a great example of this. They actually got a platform therapy designation for their AAV platform. Then they hit a safety issue last year, and that platform therapy designation got pulled by the FDA. So safety has to stay clean. The flywheel accelerates. If not, it slows fast, as we said with Sarepta. So far, Krystal's platform has held up. I mean, the drug's been launched in I think mid-2026. It'll be 3 years. So, knock on wood, starting to look good, the long-term safety. So looking ahead, management is targeting 4 additional rare disease launches by the end of the decade. Consensus models are still conservative for these. That tells you something important. The market isn't fully pricing a multi-product platform yet. It's waiting for proof. And that's the real debate. So the question isn't whether Krystal has succeeded. The question is whether the market is fully pricing what profitable, redosable genetic medicine looks like, and when it works at scale and becomes repeatable. So that's the lens we use at the Biotech Capital Compass. If you found this useful, please visit the Biotech Capital Compass, like, subscribe, or share, and thank you for your support. Sending my thanks and good vibes from Brooklyn, which is snowed in. I just went out for a walk, and it's really just refreshed me. If you're listening to this, you're somewhere at work or at home, at work, etc. It's really beautiful out there. Take care and talk soon.